Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Happy Friday to you. Oh, it's Friday the 13th.
Yeah.
Oh, dear.
Oh, no, it's always...
I think I'll go back to bed. Stay safe.
More people die in bed than anywhere else.
Oh, okay, I'll stay up.
So stay up, Bob. Stay with me. Stay with me. Bob, we have 4 listener questions, plus some interesting economic things. How about we get into the questions first?
Sure.
So our first question is from Dennis Rock, and he wants to know, Bob, can you tell me if markets peaks always happen with a negative divergence in the cumulative advanced decline line, or is that not necessary? And Bob, you'll have to explain to me what a negative divergence in the cumulative advanced decline line is.
The advanced decline line keeps track of the number of stocks that are going up on a trading day relative to the number that go down. And typically in a bull market, by the time you get to the final stages of it, not all stocks are going up. But the number of stocks listed on the New York Stock Exchange include a huge number of financials and a huge number of ETFs on other equities. So really, I've given up looking at the advanced decline line. The last few years at tradable highs, they haven't led the stock market. Typically, the ADs would lead the senior indexes. So I'm sorry, but it's just not working as it used to. So where then you have to watch for items that do work, and that's with our momentum-related stuff, upside exhaustions, and then also the sequential buy or sequential sell patterns are important, and then plus monitoring the credit market. So unfortunately, you can't make any comment on advanced decline lines now, but it used to be a very good indicator.
Cece's question for you. Bob, I know you're predicting an impending top and correction soon in the stock markets. How does that play with historical market behavior in the final year of a presidential term? Clearly, there are many who would love to see a major market correction if it would hurt Trump's election chances.
Yeah, I think on this one, we'll just deal with as a bear market or correction, how it would affect the Trump campaign. This one is unusual, but when you're in a boom, everything gets boomed and everybody in business and consumers get active. And the stock market just happens to be one item. And also within this, the left gets hyperactive and also successful. So in a boom, the left side of the politics becomes more successful than at other times. And I'm thinking that if the stock market is in a reasonable correction going into the U.S. November election, that could be a sign that hyperactive leftists are starting to deflate. I mean, it's really weird, but I think it would work. So I don't see a correction in the stock market or a slowing economy change the regard of Trump supporters for his type of leadership. And also on this, Boris Johnson in England is an outrage to the establishment, but he's won the biggest majority for the Conservatives since Mrs. Thatcher. And also the left-wing Labour Party has had its worst setback since World War II. So this is a profound election in England, and I take it as part of the popular uprising that's going on, whereby people have had it with too much in your face and too much in your wallet government, and are starting to shut those ambitious predators down. It was a timely question.
Cece's question continues here. What does history say versus current price action and economic conditions at the end of 2019? And given your concerns, Bob, would you be in the stock market at all right now?
It's difficult to get out of a market when it's so good. And they're always capable of popping up a hot group. A few months ago, in August it was utilities, and they became overbought. And then it was home builders, they became overbought. So I think if one is a trader, then one can lighten up on these overbought conditions. But then and it's also impossible to get out on the exact top day for the senior indexes. So our advice remains that on hot sectors, which we identify, it's best just to take some money off the table, and we wouldn't be buying the dips. So it's time for caution.
George Millay asks, last week listened to Bob Hoye in his discussion of the potential top in the stock market. Could he explain what bank bail-ins in Canada mean for depositors and those holding investments through the banks? Are any of Canada's banks likely to face a bail-in in the next downturn? And a bail-in is what they call, the Cyprus haircut, where the government dips into your bank account to save the bank.
Oh, yeah. No, the Canadian banking system is more sound than in many countries. I guess the best thing you can say about it is that the Canadian banking system wasn't designed by the U.S. Congress. And it goes back to a long tradition where back in 1818, I guess it was, Bank of Montreal was formed. And each of the directors of the bank was personally liable for twice the amount of money he put in. So that made for very careful banking. And then you ended up with strong banking out of Montreal, then out of Toronto and cross-country, whereas in the United States, banking you couldn't do interstate banking at one time. So Canada has a much better banking system, and they're say in the 1930s in that horrendous contraction, where in the U.S. they were shutting down something like 7,000 banks a year. In Canada, the big banks didn't fail, but they would have been shutting down branches. So a contraction isn't good for bank stocks. Now, we've had a bank rally here recently because you've had the change in the yield curve from inverted to steepening, and a steepening curve is very friendly to banking spreads. But the problem is at some point, as the curve continues to steepen, it will be saying that, hey, the contraction is on. And this is also being confirmed by the fact that you got credit spread widening, which is also a heads up on the pending correction. So, good question.
And Bob, fourth listener question for you. Let's assume that the equity markets peak in January 2020 and the bear market begins. I understand that gold would be a safe haven along with the U.S. dollar. However, as demonstrated back in 2008, the gold mining shares initially collapsed alongside the equity markets as investors needed to raise cash, but unlike the overall equity markets, did recover quickly in 2009. Bob, will this happen again?
Yeah, he got a good eye on the charts because, yeah, the downdraft in the big stock markets pulled down the gold shares, but you then you get the rebound in gold's real price, and also you can get the rebound in gold's dollar price. And he was right. The gold shares can really soar out of a severe hit to the market, and we're looking forward, well, not exactly to a severe hit right now in the marketplace, but on the next sell-off, it will then pull down the gold stocks, although over the last few weeks, maybe the action is not bad, but we played them well last year. The buy was November 1st, and a key low was the middle of November, and then in July, they got measurably overbought, and the idea was to take some money off the table. And so somewhere in here, there'll be another entry point, which we're looking forward to.
And our listeners' final question. Many silver bugs predict that silver can go to $500 an ounce and will follow the Bitcoin trajectory. Will silver be the new Bitcoin?
Sorry. I've been in the business for over 50 years, and I'm certain that for almost each of those 50 years, there's been a fundamental analyst of silver who says there's a shortage of silver and it is underpriced and it's going to go up. But we've done a lot of work on gold and silver, and the gold-silver ratio is actually a very old and at times sophisticated credit spread. It acts like a credit spread. You can call it the metallic credit spread. And when you're in a boom as we have been, the gold-silver ratio goes down, which it did. And we're watching it now because it looks like it's trying to do another rally. And when gold-silver rally ratio goes up and breaks out, it can be signaling some financial distress around the corner. And indeed, I remember in some periods where you suddenly went into a liquidity problem, and it might have been preceded by a week or so of where silver is down sharply relative to gold. And then the ideal on that one is when you have a silver bug says, oh, we can't figure out why silver is down, there's no fundamentals. But when anybody in any metal uses supply-demand analysis to then try and figure out price trends, it's a handicap. You're better off not to look at it, but we've seen some very big names in Canada look at the supply-demand analysis in gold, for example, and all the way up the huge bull market to 2011 said that somebody was holding it back. There was a conspiracy on to hold gold prices down, and yet you were in a fabulous bull market. And then, of course, the long bear market that followed 2011, they couldn't explain it. But our work integrates precious metals with major moves in the credit markets, and it more or less works. I'm comfortable with what we're doing on it, and especially also when you add in some very good technical work as well, which Ross does.
That's it for listener questions. We had a lot today, and if you have a question for Bob, you can always email us at info@howstreet.com. We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, the U.S., Mexico, Canada new free trade deal signed. What does it mean for us?
Well, it's probably better than the last one, which I criticized from day one because it really was a trade agreement by bureaucrats, for bureaucrats, and of bureaucrats. They all, Mexican, U.S., and Canadian, got together and worked out all kinds of rules and regulations. But the one thing they didn't include, and we can use Mexico, is that they didn't end the central bank's right to depreciate its currency. So then when U.S. has the senior currency, and from time to time in contractions, it gets bid up. And then from time to time, the Mexican peso went down, and as we used to call it, the northern peso also went down. So it offsets whatever actual trade agreements you've got, and it's the cheat of currency depreciation. And while I haven't read any details about this new agreement, I'm sure that it won't include having the Canadian dollar pegged to the U.S. and the equivalent with the peso. So I think it's going to be more of the same. A few years from now, the U.S. dollar will be up strongly, the Canadian could be down, or the peso could be down, in which case each of the Canada and Mexico are having a cheat on the trade agreement. And the ideal thing would be for Canada just to declare free trade in every direction and peg the Canadian dollar to the U.S., and then Canada can't cheat. So it's probably better than the previous one, and the previous one wasn't any good. So I'm not bullish on it or bearish, but but I'm very strong on real free trade. And but what it's at least taken the attention away from Trump's supposed tariffs he's been putting on. So going into year end here, they're obviously getting trade agreements cleaned up with China and also the Mexican, U.S., and Canada one. And it's a good thing to have trade agreements in place, and it's a bad thing when the other countries are allowed to depreciate their currency relative to the U.S.
We'll have more with Bob Hoye right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, U.S. small business confidence is very strong. Why is that?
There's a wave of positive stuff going on, Jim. You got a better price for crude oil than I would have thought possible. You got a better price for base metals than I would have thought possible at this time of year. And then you had this small business sentiment number came through. But on the other hand, you've got serious deterioration going on in the credit market. So it's just a strange mix at the moment. And if the stock market gets overbought in the next few weeks, we'll get a nice trade out of it.
China's companies borrowed like crazy, but can they pay back the money to all of the state-owned banks?
Yeah, here's one. China suffers biggest dollar bond default by state-owned companies in 2 decades. I mean, this is the worst hit to their bond market in 2 decades. I didn't even know they had a bond market 2 decades ago. And then the other one is China's companies that binged on debt. Now they can't pay the bill. And there's a lot in that headline, Jim, because most analysts figure the risk to bond markets is the return of inflation, in which case interest rates go up and bond prices go down. But following a great financial bubble, the problem has been a contraction. And the contraction is driven by the fact that so much debt has been floated that there's not enough earnings or money or tax revenues to pay for, to service the debt. And debt has to be serviced. So this is where you have had some of the worst bond markets in history have been in the post-bubble contractions. And you can see, investment-grade corporate bonds in some industry that's suffering, the inability to service debt, then you've got a problem there, and then you've got the rating agencies downgrading ratings, and that's the problem. In a deflationary environment, it gets impossible to service debt, and this is one of the best headlines on it, and that was, now they can't pay the bill, and that's the problem. So you've got deterioration in the credit markets, looking cyclical, looking like a contraction. At the same time, you've got some positive stuff going on in industrial commodities and U.S. small business. So we'll just see how it goes. And again, we're relying on our technical work to make some trades out of here.
Repo distortions are appearing in the European money markets. What's that all about?
That's, again, this contagion thing. And we want to go back, Jim, to earlier in the year where suddenly Argentina said that they were having a financial problem. Their currency dropped and their local rates soared. And then it was Turkey. And then you got into May or June, and then you had problems in India, and those are huge markets. And in July, you've then had stories about China reducing their currency. And I thought that was policy stuff. And then I said, hey, it's the problem where the liquidity gap is discovered in outlying exchanges first, and it spreads from one country to the next and we expected it would hit the U.S. in the fall. And indeed, this is where the repo stuff, where the U.S. Federal Reserve has injected so much cash into the money market, it's staggering. And it's holding things together at the moment. But as I've written, the amount of money they're pouring into the money market is indicative of the vacuum in liquidity that suddenly appeared. So, and then this one now is that they're using this repo term, that it's beginning to hit Europe as well. So this is a negative and confirms that the credit markets indeed are switching from being a boom to being a contraction. And not everything happens at once, and it works by stages, but these headlines are telling the story. And the way I work the headlines, Jim, is I just, you get one that's kind of sensational, And last summer, the sensational ones were all universally bullish. And now the sensational ones are very cautionary on the credit markets, and yet within that, there are some that are saying, hey, it's all sunshine with small business sentiment. So a fascinating mix.
Bob, I believe there is chat that the European Central Bank may pull themselves out of negative interest rates and at least go back to zero and perhaps a little positive. Is that a good move?
I think Mother Nature and Mr. Market will do it. If I were a central banker in Europe, I would be saying that very thing, trying to look like you're going to get on the right side of a developing contraction. The reason why the interest rates went so low is that it's a much smaller market than the U.S. market for, say, long bonds. And the central bankers have had this crackpot theory that if they issue credit, it drives the economy. But that's arbitrary. And what happens is that when the public wants to speculate in stocks and bonds, the action goes into financial speculation and not into the economy. So it's a crackpot theory about the central bankers injecting credit, but they're injecting it at a time when it doesn't go into building plant and equipment. Then it goes into financial speculation. So, interest rates in Europe will go up, but it won't be due to policy. It'll be due to market forces, as I say, like this one for China, where all of a sudden those who have ambitiously borrowed the money have got to face the problem of servicing the debt, and then that's when you then get default. So, yeah, I fully expect interest rates in Europe to go up hugely, and the minus interest rates is the strangest anomaly in the history of the financial markets, and it's due mainly to a crackpot central banking theory. And it'll be interesting to watch all this get adjudicated by Mother Nature. And also you got Mr. Margin out there too when prices decline. So next year is going to be very interesting.
Bob, thank you so much for chatting with us.
Yeah, well, we had a good one, Jim. We've got headlines and we've got some 4 very good questions, and that's a nice way of doing the interview.
And again, for our listeners, if you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. You can find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.